Okay, new positioning for today's video. We'll see if we like it. It's been a volatile week. We started the week off with multiple 1% plus intraday swings, multiple in single days. And here we are. We've had a tremendous rally. Now we're entering the Fed's blackout period, and we'll get into that. I might have my own blackout period next week, not because I don't want to work. I'm going to be working, I'm going to be tweeting, but because I don't want to be unnecessarily repetitive. And I don't think the Fed's blackout period really means anything, and we should just take what they're saying and run with it, not fight the Fed. They've got a very clear objective, and they have a very clear plan that they're going to execute despite the resistance against it to have their goals come to fruition. So today, blackout period begins. However, just before the blackout period begins, they have the three most hawkish members of the Fed come in and talk and say very important things that they don't want the market getting ahead of themselves. The first of which being, probably teeing off everything else that follows, Bullard saying the market is underpricing rates being higher for longer. Okay? Is that enough for you? The Fed's telling you the market's incorrect. Are you going to listen to them or are you going to fight them? That's your decision. I'm not fighting them. The next important standout thing to me that I think is quite important and is in a similar vein is Bullard, I believe, it might have been Waller, saying that, I totally lost my train of thought. This was a super important thing. One moment. Saying that, what was this thing? It's gonna make so much sense as soon as I say it. I'm tempted to almost restart the video. I do all these things unscripted. I just need to focus and think for a second. Okay. Higher for longer. Oh, this is the big thing. So, everyone in the market is talking about how, if next week's CPI isn't so hot, if we get a better than expected CPI, the Fed's going to have to not tighten as much, inflation's going to be coming down, and the market is going to rally. Well, guess what? The Fed probably has good information, and they said even if we get a good CPI, we still have to be aggressive and continue to hike rates. So, the Fed's telling you the market's underpricing, higher for longer, and they're telling you no matter what happens with CPI, they're going to have to hike rates. I don't know what else you want. I mean, I can't get bullish. I can't be buying tech. I can't be buying rate-sensitive stocks right now. I just cannot. As a matter of fact, I'm getting concerned because the market is underpricing higher for longer rates. In addition, the market is continuing to expect tremendously high earnings. When we're seeing growth rates slow, Apple's growth rate slow, I'm not impressed by the new iPhone, although I already ordered it. China lockdowns. I don't know if they're going to have the supply. I was trying to get one to pick up in store. I can't get one to pick up in store. I have to wait till October to get it shipped. I'm pissed. And I ordered it at like 8:15 in the morning in Austin, Texas. So, interesting scenario here. Interesting scenario. Oil prices down. I'm starting to see the November contract up more than the October contract. That might be because the November contract is slightly less expensive, but it could also be, and it will probably also be once it becomes November and December, the notion that the strategic midterm reserve is ending at the end of October. That's not going to be present in November. Yet demand is remaining quite strong. It's not really tailing off, especially now with prices low. Demand is remaining hot. So I'm expecting once that strategic midterm reserve is over, once the midterms have occurred and the Republicans have taken control of the House and the Senate, they're going to be more than happy not to unload the strategic midterm reserve, and they're just going to want to coast, and prices are going to rise. And the Republicans take control. It's not so good, right? Not so good. Not so good, is it? Just kidding. It's probably going to be good. It's going to be less aggressive spending. Well, there's a lot of uncertainty, though. And that's the thing. There's a lot of uncertainty, in my opinion, to the upside. It's a lot of guesswork on the upside. It's a lot of guessing, trying to outwit the Fed, trying to say, oh, this time is different, we should fight the Fed. Look, the Fed got it wrong on the way up. They let inflation run too hot. But that doesn't mean it was a good idea to fight the Fed just because they got it wrong, okay? Understand that, please. Likewise, fine. Maybe the Fed's going to over-tighten. Maybe. I don't know. Maybe. But that doesn't mean you fight the Fed. The market is in a crash. Look at the year-to-date chart. Look at a one-year chart. The market is going down. That's what it's doing. The fundamentals are deteriorating. They haven't even begun, really, to start. We've talked in past videos about how there's going to be a wave of growth company bankruptcies. This is coming. Why is it coming? Because rates are going up. They're going to be up for a long time. It's going to be hard for these growth companies to get cash. And how have they been getting cash? They've been selling equity. Well, the equities are down. Rates are up. Less people want to give them equities. The IPO market has dried. Very little potential for new issuance, new supply of stock in the market. Very, very difficult for that. So these companies are they're just going to run out of cash. That's what's going to happen. And some of them are going to have to declare bankruptcy. And that hasn't even begun. And once that begins, ARK is not going to rally on that. That's not the bottom of ARK. There has to be a flush out. There has to be a number of bankruptcies that hasn't even begun. High yield is still not that good. It's going to get good. We're going to have to wait for next year. And, these are just all bear market rallies. As a matter of fact, what we're going through right now, I think, is not even strong enough to be a bear market rally. It's a rally off it's like a comeback. It's like a small spike in an overall downtrend that we're currently experiencing off of a bear market rally. It's like if a bear market rally, well, granted, is like a rose with the branch. What we're going through this week and maybe next week with some CPI leading into the Fed, which will hammer it back down yet again, is a thorn on that rose. Okay? This is my take. I can be wrong. It's definitely possible. I can change my mind and I can pivot. But as of right now, this is my assumption. This is how I'm positioned. This is how I'm expecting things to go. I'm short. I've added more shorts today. And I anticipate to add more shorts prior to the Fed meeting. After CPI. I'm keeping that window open. Maybe we go down right after the CPI. I don't know. We're going to see what happens. But something I feel very confident in is the Fed's path, not fighting the Fed. I would not do that. It's my opinion. You're welcome to do what you want. I have some Jumia. I have some StoneCo. I have some growth stocks. But they are small positions compared to my energy companies, compared to my shorts, these kinds of things. So, the market's expensive, the economic outlook is deteriorating, and the Fed is hawkish. Get bullish, get long, and take that risk at your own peril. Just know the contents of this video. If you want some more content, please follow me on Twitter. And if you haven't done so already, please like and subscribe and turn on post notifications. Why not get in these lives? Happy to answer questions. Absolutely. That's what I do. Just try to help. That's what these videos are about. So if you got any questions, happy to answer. I wish I could bring people on live with me. Maybe there's a way to do that. I'm kind of just clicking through all the buttons right here. I'm not seeing anything. So maybe another time. But that's today's video. And until next time, and have a good weekend. Peace out.